You're an E&P company. Suddenly, there's a disruption in the field. How quickly can you reschedule your resources with that spreadsheet you're using? With Actinem software, an AI-powered optimizer responds to any changes and quickly resequences the schedule to keep you on track to meet your goals.
Good morning and welcome to this week's What's Affecting Oil Prices. I'm Ashley Peterson, lead oil analyst here at Stratas Advisors. Brent fell $1.15 a barrel last week to average $62.50, exactly in line with our forecast, with the OPEC Plus meeting providing significant support at the end of the week. Brent will likely drift slightly lower this week from Friday's levels, averaging at least $63.50 a barrel. Now that the OPEC meeting has concluded, attention will return to the outlook for demand next year. The December 15 deadline for another round of U.S. tariffs on Chinese imports is fast approaching, with no apparent progress made on postponing them as part of the current uneasy truce. Additionally, the most recent customs data shows that Chinese exports fell for the fourth month in a row, adding to concerns about the global economy. For the week ahead, any headlines about U.S.-China trade talks could have an outsized impact on prices. Geopolitics will be a neutral factor for the week ahead, although protests in the Middle East and Hong Kong continue. The global economy will be a negative factor in the week ahead. In advance of the OPEC Plus meeting, traders effectively erased many bullish positions put into place, likely as a matter of short-term profit-taking. However, while the new supply agreement is supportive for first quarter prices, managed money net positioning is still unlikely to rally through the end of the year as demand concerns persist. Supply will be a positive factor in the week ahead. OPEC Plus surprised markets with a deeper-than-expected supply cut, although the original March deadline remains in place. Oil demand will be a neutral factor in the week ahead, as most enclaves are showing seasonally normal product stock movements. U.S. crude runs, especially in Pad 3, will continue to grow in the weeks ahead, likely leading to product stock builds. Runs traditionally increase at the end of the year, in part due to tax regulations in place that incentivize minimizing crude held in storage. This is also likely to lead to product stock builds, which could play into already bearish sentiment about demand.
This weekly report is an excerpt from our short-term price outlook service analysis. For more information, please contact us.
You're an E&P company. Suddenly, there's a disruption in the field. How quickly can you reschedule your resources with that spreadsheet you're using? With Actinem software, an AI-powered optimizer responds to any changes and quickly resequences the schedule to keep you on track to meet your goals.
For more hard energy videos, follow our social media channels.